Stop staring at the ticker tape in New York. If you're checking the COMEX price on your phone, you're not looking at the silver market. You're looking at a story the paper market tells itself. Yes, right now you see silver around $74.59. You see green candles. You see a $3 spike and think, okay, this is the move. But that screen is a ghost price, a derivative price, built on the assumption that silver is always available, in unlimited size, whenever somebody wants it. If you want the real price, the price the world's factories are paying, the price that decides whether production lines keep running, you have to look 5,000 miles east. You have to look at China. Because in China, the physical market is trading at a premium that converts to roughly $100 an ounce. Do you understand what that means? That's not a normal spread. In professional trading, a $25 gap between major markets is a broken market. It is an arbitrage vacuum so powerful it behaves like a black hole pulling every available ounce out of the West and dragging it toward the East. And in this emergency market update, we're going to dissect the China $100 phenomenon, why the U.S. paper market is lagging behind physical reality, how the arbitrage flow drains Western vaults, and why the price in New York eventually has no choice but to chase the higher bidder. Because when the dam breaks, price doesn't negotiate. It snaps. Here's the key. You must understand the difference between spot and street. In New York, spot is basically the price of a futures contract, a paper promise. It's clean. It's liquid. It's tradable. And it quietly assumes the system can deliver metal forever. But in China, demand isn't paper. Demand is atoms. Solar manufacturers need silver paste. EV companies need silver contacts. Citizens want bars for wealth preservation. They don't want a promise. They want metal in hand. So when millions of buyers compete for a limited supply of physical ounces, price stops behaving like a chart and starts behaving like a survival auction. Reports are showing something critical. The official Shanghai price might translate around the high $70s. But the real-world premium the layer paid to dealers, refiners, and intermediaries has exploded. If you want immediate industrial-grade delivery in places like Shenzhen, you're not paying spot. You're paying close to $100. And when a local market rises, $1.25 above the global benchmark, that signals one thing. Inventory is gone. A localized famine. China is starving for silver, and they're willing to pay any price to keep the factory lines alive. Now watch what that does to the West. Western banks are short silver in New York around $74. While physical metal is being pulled east toward $100, that means the shorts face a nightmare. They can't cover paper with paper. To close this gap, you need the only thing the market is running out of: bars. Let's do the arbitrage math, the simple mechanism that forces the U.S. price higher. If you're a global bullion dealer, you have a choice. Sell a bar in New York for $74, or ship it to Shanghai and sell it for $100. Even after shipping and insurance, the profit is massive. So the trade becomes obvious. Metal leaves the West. London, Zurich, New York. Anywhere there's inventory gets swept and allocated for export. And as Western supply thins, the paper price loses its anchor. Because once physical availability hits a wall, the paper market doesn't discover price. It confesses it. This is why the decoupling matters. For decades, COMEX pretended to set the global price. If silver dropped in New York, it dropped everywhere. That relationship is breaking because consumption now dominates speculation. China consumes. New York trades paper. And the consumer always sets the final price. If major manufacturers are willing to pay $100, then silver is worth $100, because that's the price where real transactions occur. You can already see the proof in your own backyard. If China is $100, why aren't U.S. dealers selling at $74? They aren't. Check any major dealer. Spot might say $74, but a silver eagle is often priced closer to $90, $95. That's the physical market whispering the truth while the paper market tries to keep its face. So here's where we are. The physical world is repricing silver upward. The paper world is lagging. And the gap itself is creating the force that closes the gap. This is the $25 vacuum. And next, we need to talk about the most dangerous part of the equation. The banks trapped on the wrong side of this spread. Now we need to talk about the banks. Because every time silver trades near $100 in China, it acts like a silent margin call on the entities short silver in New York. Normally, banks love arbitrage. A $2 gap? They step in. A $5 gap? They feast. But a $25 gap should be a license to print money, unless you're remissing the one thing arbitrage requires: physical metal. You can't ship a futures contract to Shanghai. You can't settle an industrial buyer with a PDF. You need bars. And the banks don't have them. They leased them. They sold them. They rehypothecated them. They built a system assuming nobody would ever ask for the metal all at once. Now they're discovering that assumption was fatal. The vaults in London, once the safety net of the Western silver system, are running on fumes. COMEX's inventories look adequate on paper, but registered metal, the metal actually available for delivery, is thin, fragile, and shrinking. That's why the banks are frozen. They can't step in to close the arbitrage. So the arbitrage is closing them. Every uptick in Shanghai forces a mark-to-market loss on U.S. shorts. Every dollar higher tightens the noose. And this is why the strategy has changed. For decades, the playbook was cap and contain. Dump paper, push price down, manage perception. That strategy only works when physical demand is passive. Today, the strategy is survive and exit. And you can see it in the data. When price rises and open interest falls, it tells you something critical. Shorts aren't adding pressure. They're leaving the building. They're buying back old positions. They're stepping aside. They're removing the ceiling they once controlled. This is how markets go vertical, not when buyers arrive, but when sellers disappear. And right now, the biggest sellers in the room are quietly retreating. This is why shorting silver has become a widowmaker trade. In finance, a widowmaker is a position that looks logical, right up until it destroys everyone who touches it. Shorting Japanese bonds was a widowmaker. Shorting tech in 2023 was a widowmaker. Today, shorting silver is the ultimate one. Why would anyone stay short when physical silver is trading a 30% premium in Asia? They wouldn't. The only shorts left are the ones who can get out positions so large that exiting would detonate the price instantly. They're trapped in a burning theater with one tiny exit. And if even one major player panics, if one bank decides survival matters more than optics, we don't get a rally. We get a melt-up. A single forced exit could move silver $10 or $20 in a day. We saw a preview of that earlier this week. Now add the calendar pressure. Tomorrow is December 31st, the final trading day of the year. This matters more than people realize. Portfolio managers are judged on year-end closes, bonuses, performance rankings, reputation. If you're long silver, you want the price marked high into the close. That creates an incentive to buy strength, not sell it. At the same time, tax loss selling, one of the last sources of artificial pressure, ends tomorrow. So what do you have? Funds incentivized to push price higher. Sellers stepping away, banks covering. Physical demand screaming. That is not a recipe for a pullback. That is a launch pad. And you can see the stress spreading into the dealer network. Something unusual is happening in the U.S. physical market. Dealers are offering above spot to buy metal. Think about that. Normally, if you sell silver, you get spot minus a fee. Now dealers are paying spot plus $2, plus $5. Why? Because they're empty. Refiners are closed. Wholesalers are dry. and China is outbidding everyone. When the buyback price exceeds the futures price becomes irrelevant. It proves the physical market is tighter than the paper market admits. This drains liquidity from COMEX, even further making every price move more violent. And now we arrive at the industrial panic. Why is China paying $100? Not speculation, not mania, inelastic demand. If a solar factory runs out of silver paste, it shuts down. If an EV line halts, losses are counted in millions per day. So when silver rises from $75 to $100, the factory manager doesn't debate it pays. Because the cost of silver is trivial compared to the cost of failure. That's why industrial demand sets the floor. Investors choose to buy. Industry must buy. And right now, industry is panicking. Layer on top of that a weakening yuan, collapsing property confidence, and retail capital fleeing into metals, and you get a dual-engine rocket. Industrial desperation below. Retail hoarding above. This is why the paper price is falling behind. And this is why the market is about to snap higher, not gradually, but suddenly. Next, we need to look past December 31st to January 2nd, 2026, when the real money arrives. Because what's coming in January makes everything you've seen so far look small. Stop watching the New York ticker. The COMEX price on your phone, $74, green candles, a $3 spike, is not the silver market. It's a paper hallucination, a derivative price built on the assumption that silver is infinite. If you want the real price, look 5,000 miles east. In China, physical silver is clearing near $100 an ounce. That is not a spread. That is a broken market. A $25 gap between New York and Shanghai is an arbitrage vacuum so powerful it pulls metal out of the west and drags it east. This isn't speculation. It's gravity. New York trades paper promises. China buys atoms. Solar factories need silver paste. EV lines need silver contacts. Citizens want bars, not PDFs. When buyers compete for a limited physical supply, price stops following charts and starts following survival. Official Shanghai prices may translate to the high $70s, but real-world premiums explode the moment you demand immediate delivery. Industrial buyers in Shenzhen are paying close to $100. That means inventory is gone. And that creates a nightmare for Western banks. They're short silver at $74, while the metal is being sold at $100 elsewhere. To close that gap, they need physical bars. They don't have them. They leased them, sold them, rehypothecated them. The London and COMEX vaults are thin, fragile, and shrinking, so the banks can't close the arbitrage. The arbitrage is closing them. Every $1 rise in China is a margin call on U.S. shorts. And the data shows it. Price up, open interest down. Shorts aren't fighting anymore. They're leaving. This is how markets go vertical. Not when buyers rush in, but when sellers disappear. Add the calendar pressure. December 31st matters. Funds want strong year-end marks. Tax loss selling ends. Incentives flip from selling to buying strength. At the same time, U.S. dealers are paying above spot for physical silver. When buyback prices exceed futures prices, the paper price is irrelevant. Industry doesn't care about charts. If silver hits $100, factories pay it, because shutting down costs millions a day. That's inelastic demand, and it sets the floor. Now, fast forward to January 2nd, global pension funds manage $50 trillion. If just 0.1% reallocates into silver, that is $50 billion chasing a market whose entire annual mine supply is worth $25 billion. That's not bullish. That's impossible unless price reprices violently. This is why $100 silver isn't hype. It's necessary to ration demand. Now the exit. Selling silver for dollars is a mistake. Smart money swaps assets. Watch the gold to silver ratio. Above 40. Hold silver. Around 30. Partial swap. Near 15. Full rotation into gold. That's how wealth survives cycles without returning to fiat. Final verdict. China is setting the price. The West is lagging. The paper market is cracking. The physical market is in control. The $25 vacuum is closing. Not slowly. Not politely. 2026 is the year silver forces reality back into the price. And if you're holding it, you're already ahead.